Hello, everyone, and welcome to Mawer's 2021 Live Insight Webcast. My name is Janelle Hart. I am an investment counselor at Mawer, and I will be your host today. We are excited to be meeting with you all again virtually this year and look forward to answering the array of questions that we have received in advance for our 4 panelists today, as well as some live ones that come in. We would like to start by acknowledging that we are grateful to have the opportunity to host this session in the traditional territories of the Indigenous peoples of the Treaty 7 region and Métis Nation of Alberta, Region 3, and that we have participants in this webcast who are working and living in the traditional land of many other Indigenous peoples. We share the responsibility for stewardship of this land as well as to its First Peoples, both past and present. Mawer is committed to elevating Indigenous voices and collaborating to advance reconciliation. Next, I would like to introduce Mawer's Chief Investment Officer and the co-manager of Mawer's Global Equity Fund, Paul Moroz. Paul is going to share a presentation with us covering many of the topics that have been on investors' minds this past year. We welcome you to submit any additional questions during this session at slido.com using the event code Mawer. The link is also in the reminder email that was sent yesterday. A recording of this webcast will be available on our website within 24 hours in case you cannot stay with us for the full hour. And without further ado, over to you, Paul.
Thank you very much, Janelle. I'm happy to be here chatting with everyone. I'm going to share my screen and a presentation that I have, and hopefully that will generate a little bit of insight just as to what is going on in the world. So let's start with the economy. And you might recall that last year I showed this similar chart. This is the Purchasing Managers Index by country. Red is bad. It means manufacturing companies and businesses aren't really ordering as much. Green is good. It means you're ordering more. Last year, I talked about recovering from a heart attack, whereas this year, we're talking about demand recovery. And we've seen that in the economy, lots and lots of green. So that's the first thing that's going on. Now that has translated into earnings growth. And so the next slide here shows a couple different charts. On the left side is Europe, on the right side is the United States. And the lines that are heading up, well, those are stock prices, but also forward earnings expectations. And the comment here is that even though equity markets have become a little bit more expensive in terms of the price going up, well, earnings have grown. And one of the things to consider is when we look at the price to earnings ratio over the last couple of years, you're seeing that earnings growth has offset the price increases. So I'm not saying that price to earnings ratios are the end all be all of valuation, or I'm not suggesting that the starting point was particularly cheap or expensive, but I'm saying that there has been an offset. And at this point in the cycle, you would expect strong earnings growth from companies as the economy is doing well. What else has been going on? Well, inflation. It's a little bit of that 70s show. And this chart you're looking at here is basically US inflation year over year, consumer price index. And as you've seen in the grocery stores and other places that you're shopping, prices are up. And in some places, they might even be up even more than the 5 or 6% most recently showed in this graph. Now, what's behind that? Some of this relates to supply chain challenges. One of the things that's been going on is it's been tough to ship goods out. Go back to that Christmas tree slide and consider that the economy had that heart attack. Purchasing managers stopped ordering, and then all of a sudden they started up again, and everyone wanted their, whether it's bicycle parts or shoes or whatever it is that you're buying, And the whole economy kind of lurched forward, and that has helped back up ships, and those shipping costs have increased by a factor of 4. That's rolled off a little bit more recently, but it just illustrates the supply chain challenges that the economy has. Another thing going on is commodity prices have increased. And the last year and a half, whether it is the general commodity price index or oil and gas prices, that has increased, and that's feeding into a little bit of inflation. We're hearing from a lot of companies how they are trying to pass price increases to the consumer because their costs are rising too. Now, as a result of this, investors are starting to react to the likely central bank reaction. And this is at the shorter term end of the yield curve. We'll have Crista on here to talk more on the bond side, but whether we look at in Canada or the US or the UK, even though rates or yields for 2-year government bonds are low, the delta or the change is increasing. This next slide just shows the Canada 10-year bond yield. And we've titled this slide, "Where are the bond vigilantes?" Because at the 10-year mark in the yield curve, I mean, the bond yields are really not responding to the same level of inflation that we're seeing. There's a lot of people out there that think inflation is transitory, that these supply chain bottlenecks and commodity price increases will get resolved with time. And that might be one explanation for what's going on in the bond market. There might be another explanation in that maybe governments or central banks are really financially depressing markets, and these bond yields should be higher. There's different arguments. Certainly what's been going on in China in terms of their real estate market would suggest deflationary pressures that might spill over. So it's a bit of a puzzle. It's not so clear, but that's the picture of Canada 10-year bond yields. Now, what does this all mean? I think that the takeaway that I want to leave people with is there's a lot of uncertainty out there in the world. And what we try to do is prepare, but not predict the outcome, because there is such a wide range of ways this could go. There's a possibility inflation increases more and central banks have to react with higher interest rates. And that means that asset prices all around the world would come down. You could see equity markets being off 20 or 25%. And you have to prepare for that sort of outcome. You also have to prepare for an outcome that that inflation is transitory, that we actually have deflationary pressure spilling over from China, that earnings growth continues to be good, and equity prices march up another 20%. That's a very different scenario, and I think it's important to be balanced in our thinking. So I wanted to share just briefly how we think about portfolio construction in action. On the equity side, given this uncertainty, what you're looking at here is our global equity matrix. As a reminder, all the companies that we put into the portfolios, we plot on this matrix. The vertical axis represents the quality of the business and management team and risks. And then the horizontal axis represents the return potential. So the highest potential companies plot towards that very top right-hand corner. And as a company is either lower return potential or lower quality, we now have a tool to help debate the merits of that business and determine an appropriate weight or whether the security should be in the portfolio at all. What I want to bring to your attention is the overlay that we use with the matrix, and that is thinking about some of the other special factors that creates a more resilient portfolio. I want to highlight ICE, US. This is Intercontinental Exchanges. We hold it in the global equity portfolio. It's in red here. You see where it plots, but it has some other special qualities that are attractive in this environment to help create a resilient portfolio. They manage financial exchanges. They provide software and data to their customers. And as part of their financial exchange business, they provide the marketplace for a lot of commodities and energy contracts out there in the world. So, for example, they facilitate the trading of Brent oil contracts. And that's a particularly neat business because if you are in an inflationary environment, if you are in that scenario where commodity prices, agricultural prices are increasing in price and volatility, their business is going to benefit from that. It works out well in that scenario. The management team has also made strides to make the portfolio more resilient within that. So, for example, that financial exchanges business, which is about 65% of earnings, within that is an energy business, about a third of that. And there's a good third of that where they've already transitioned to clean type of energies. In fact, they are involved in 4 of the biggest carbon cap and trade markets in the world. So as the world transitions even within those types of commodities, they're evolving too. So that's just an example of how we think about creating resilient portfolios and making sure that things are really diversified. The key takeaway to consider is please prepare as opposed to predict. I'll turn it back to you, Janelle. Thanks.
Thank you, Paul. That was a great summary. I like your comment, prepare but not predict for what may come. I would now like to introduce the rest of our panelists today, starting with Crista Caughlin, who is the lead manager of Mawer's Canadian bond and money market strategies. We also have Christian Deckart, our Deputy Chief Investment Officer, as well as the co-manager of the Mawer Global Equity and Mawer Global Small Cap Funds. And finally, we have Jeff Moe, who co-manages the Mawer New Canada Fund and manages our recently launched US Mid-Cap Equity Fund, which we're very excited about. Now, let's dive into your questions. To kick things off today, I thought we could start talking a bit more about interest rates. And Christian, I'm hoping you could tell us a little bit about how interest rate changes this year have impacted different asset classes.
Yeah, so just generally to set the context, why would higher interest rates impact the value of any portfolio? Well, that's because financial assets, their price today is the net present value of all future cash flows. So the higher the rates, the lower the net present value of all assets. And when I say all assets, I mean all assets. So whether it's bonds, Krista's home turf, or equities, Jeff's, Paul's, my home turf, or whether it's real estate or alternative investments, all income producing assets, the value of them depends on interest rates. And so as interest rates go up, their value tends to come down. Now, the problem is that, let's stick to stocks, a stock price movement has never written a Y on it, or I should not say never, but really rarely, except for in a case where there's a profit warning and the stock is down 15%. We don't know why stock prices do what they do in the short run. They're totally random in the short run. Only in the long run, the trends may emerge. So often we hear reasons quoted on the news for something, but in reality, no one knows. No one knows why something happened in this world. Think of September 11th. No one knows the real reason why it exactly happened that way. And same with stock prices. So we don't really know what the impact was. We can only speculate, and we try to avoid that because I think, as you and Paul said before, we try to prepare and not predict. And what does that mean in this context? Well, we have readied our portfolios for all different types of scenarios, and have thought of the fragility or the resilience of our portfolios in all sorts of scenarios instead of trying to predict what exactly will happen.
Thank you, Christian. And maybe we can dig a little bit deeper into the impact of interest rates. Jeff, we had a specific question about how rising rates could impact dividend-paying stocks in Canada. Could you explain?
So, Janelle, as Christian was saying, when interest rates rise, the net present value of the future cash flows of a company decrease. And when we say future cash flow, we truly mean all the cash flows from now until perpetuity. Obviously, with the way the discounting mechanic works, for those of you who are familiar with it, the longer the cash flow is dated, the less value it is in today's dollars. So you would rather have profit earned tomorrow rather than profit earned 20 years from now. That dollar of profit earned 20 years from now is worth a lot less to you as an investor today. And so, as Christian was saying, as interest rates rise, all equity prices or all asset prices are impacted. And so dividend-paying stocks in our Canadian equity fund would also be negatively impacted by rising interest rates. However, they would be less negatively impacted than some other companies in the portfolio. And this is because of a concept called equity duration. And essentially, the way you think about duration is how long dated are their profits. So I'll give you an example. Take, for example, our holding in the Canadian equity fund, Shopify. So this is a technology company. They're growing very fast. They are now the largest provider of online e-commerce websites for small merchants globally. For them, though, their promise to investors is we are investing right now, and then in 5 years, in 10 years, in 15 years, we'll have very large profits when we have grown to be a much bigger company and we are able to generate a lot of profits. And so for that company, their equity duration is very long. And so when interest rates rise, they are impacted quite a bit more than, say, a Royal Bank of Canada, which has high profits today, but only modest expectations of growth every year. And so a company like Royal Bank of Canada is paying a high dividend today because they already have lots of profits that they don't need to reinvest to capture the growth that Shopify is trying to capture. And so disproportionately, the dividend-paying stocks tend to have high profits today. That's what allows them to pay a dividend today. And they therefore have lower equity duration, and they will actually be less impacted. The only other thought is the point that Paul was making, which is while inflation is rising and while short-term bond yields, like a 2-year bond yield, is increasing, that's not coming through in the 10-year bond yield. So you could have a situation where the short-term interest rates go up, and therefore the short-term discount rates that we use in our models go up. But the long-term discount rates stay relatively unchanged, and the long-term discount rates don't change. In that scenario, you could see a company that pays a high dividend today, like Royal Bank, they may be hurt slightly more than long-duration equities. But generally speaking, when interest rates are rising, it's bad for all equities, but less bad for dividend-paying equities than non-dividend-paying equities.
Got it. Thanks, Jeff. Those were good examples. And more broadly, could you share your outlook for the Canadian equity market in general after such strong performance this year so far, including the oil and gas sector?
Knock on wood that we can finish strong as well. I'd say there's two main reasons that we see why the Canadian equity markets have done so well. The first is the general economic recovery that Paul alluded to, that Christmas tree graph. Lots of green generally means lots of earnings growth, which has happened for Canadian equities as well as all other equities globally. And then specific to Canada as well, I think Paul also alluded to this, commodities have been doing very well. And as many of you know, Canada is a land of rocks and trees. We have a lot of commodities to export to the world. And of course, under those rocks and trees, we have a lot of oil as well. And oil, again, is back to the highest point it's been since the original crash in 2015. And so those are the two factors driving Canadian equities higher. And when we look forward, it seems like the economic recovery continues apace. And so we, while not, again, we don't spend a lot of our mental energy here at Mawer trying to predict the future. We would rather prepare for the future by diversifying. Nevertheless, we don't see any clouds in the horizon for an economic recovery. I mean, some clouds we have talked about already, like if inflation gets too high or if supply chains get bottlenecked. But generally, that's a sign that people are wanting things and people are demanding goods and services. And so as long as that is, the growth of that is managed, the Canadian economy should continue to recover from the early pandemic lockdowns. The second piece is the kind of the commodity sector, especially oil and gas. And whether it is continuing to be an attractive area to invest is less certain. As with all commodities, over the long term, the price of a barrel of oil or a pound of copper should converge towards the marginal cost of producing the last barrel that's demanded by the public. And so when you look at economists and you look at their projections, oil demand is still going to grow modestly, and that incremental last barrel of demand is probably costing around $50 to $60 US to produce. That number hasn't changed very much when we read what the economists are predicting and the cost analysts in oil and gas companies. So over the long term, that probably should be where the price of a barrel of oil should go. But in the short term, as Christian was alluding to, markets are random. It's possible that oil prices could stay at $80 for a period of time. They could go to $120 from here. We don't know where it should go. The only real kind of fundamental marker we can pin our hat on is the cost to produce the incremental barrel is probably in that $50 to $60 per barrel range. Oil is a commodity, therefore it should trend over there, but it could take 12 or 24 months depending on how things go, or it could go even longer. Again, it's very uncertain, but looking at it right now, that would be why we're perhaps a little bit more cautious when we look at oil and gas companies.
Thanks, Jeff. All right, let's move on to bonds, which seem to always bring about some debate. Crista, could you talk about what has gone on in bond land this year and how we've positioned ourselves within the Canadian Bond Fund?
Yeah, sure. So we have seen an underperformance in bonds this year. And that really comes back to, we saw a pretty material backup in interest rates, particularly given the low starting point. So if you go back to this time last year, our 10-year rate was sitting at around 50 basis points or 0.5%. And then earlier this year, we saw economies open up, we saw growth improve, we saw improvement in employment markets. Obviously, inflation has picked up. And as a result, we've seen central banks start talking about tightening monetary policy. And this caused interest rates to move materially higher. We're now sitting at around 175. I think we hit 180 yesterday in the Canadian 10-year. So that's a 125 basis point move in interest rates. And it was really that increase in interest rates, particularly given the low starting point. So we didn't have a lot of yield to help us absorb those higher rates. That has had a negative impact on bond portfolios. In terms of what we're doing in the Canadian Bond Fund, there's a few things we do to help mitigate the downside to rising interest rates. We bought shorter dated bonds that have a shorter duration. We can also buy higher quality corporates and provincial bonds, which offer a higher yield, which again helps mitigate the downside to rising interest rates. That's specifically in the Canadian Bond Fund. The other thing we're doing is an asset allocation strategy. We've had a reduced exposure to fixed income over the course of the year, again, to mitigate portfolios to downside in interest rates.
Okay, thank you. So then how should an investor consider bonds within their portfolio moving forward? You mentioned that we've kind of decreased our exposure a little bit. I think the big concern here is if interest rates do continue to rise, that bond values could continue to fall.
Yeah, I mean, I think investors should consider bonds the same way they always have. They are a source of income, but more importantly, bonds offer really attractive diversification benefits in the context of balanced portfolios. Paul talked a lot about the various scenarios that could play out. In some scenarios, bonds really help your portfolio. In terms of rising interest rates, that's definitely a concern. That's often a concern. I think our view is the biggest move in rates is likely over, at least in the near term. I think we have a more balanced outlook for bonds over the course of the year, particularly relative to last year, just given the amount of, sort of the move we've already seen in interest rates. There's already 5 hikes priced in by the Bank of Canada into the market. So that takes our overnight rate from 25 basis points to 150. For context, the Bank of Canada really only got to 175 in that 2017, 2018 hiking cycle. Longer rates are actually higher than where they were back then. So we're higher than sort of pre-pandemic levels. So we believe it'll be challenging for the Bank of Canada to raise rates even further, just given how much debt exists in the private sector. We all know Canada sort of has one of the most indebted private sectors globally. As the Bank of Canada raises rates, debt becomes more costly to service. It also becomes more expensive to continue borrowing. And so there's really a limit to how much you can raise rates without really causing a material slowdown in growth. And so granted, we don't really know where that limit is, but we're using the previous cycle as a gauge. And so if we use that as our goalpost, we see rates kind of in that 2%, 225, maybe 250, but we don't see another 125 basis point move next year like we saw this year. Having said all that, we do tend to think in scenarios. We realize there's multiple ways things could play out. We want to prepare ourselves if things are evolving differently than we think. And so we spend a lot of time thinking about that in inflationary scenario, paying close attention to it. And that's really the scenario where inflation is structurally higher and central banks have to raise rates significantly more to control it. On the other side, there's also a number of headwinds to growth next year that we see. China, there's issues in China's credit markets that we sort of all know, we're all aware of. There was a lot of fiscal policy this year that's not going to get repeated next year. We're seeing tighter monetary policy, tighter financial conditions. If any of those factors end up being a bigger contributor to, or end up being a bigger factor on growth, you could actually see rates moving lower. So all to say, increasing rates is definitely a concern. There's a number of ways things could play out. We did just have a large move in interest rates, and we don't expect that to be repeated, but we'll see.
Okay, that was really helpful, Crista. Thanks for describing it that way. Though I think one other concern in that structurally higher inflation scenario you described is whether bond returns can keep up with rising inflation rates over the medium to long term. What's your take on that?
Yeah, I mean, if inflation continues to move higher and causing interest rates to continue moving higher, initially bond returns won't keep up with inflation. However, historically, at least over sort of a cycle, they do average. They typically sort of average sort of similar levels. And the way it works is as inflation rises, bond returns obviously underperform. Once you hit, once inflation stabilizes, even if it's at a higher rate, inflation stabilizes, interest rates stabilize, you kind of are in line. And then obviously if inflation falls and interest rates fall, bonds outperform. And I think the real factor here that sort of causes you to sort of be in line with inflation over a cycle is this idea that you can reinvest at a higher interest rate. And so it's important to remember, our portfolios are not static. As inflation moves higher, as rates move higher, we're constantly reinvesting at that higher level of interest rate, which really ends up helping bond returns.
That's a good reminder. Thank you, Crista, and for describing all of those potential scenarios for us. I think you've earned a break for now. So let's move over to Paul. Paul, could you explain what caused the market volatility that we experienced in September of this year? And specifically, how did Evergrande play into that?
Well, Evergrande, you said that, did you use the term spillover into Janelle?
No, I didn't.
Okay, I was thinking, someone asked me about this before. They said, well, how has what was going on in China, are you concerned that that's going to spill over? And my comment was, well, the issues in credit market or communism? I wasn't sure what they were referring to. Anyway, that's my one stock market joke. What we had is a very large real estate company that was effectively misallocating capital and looked like they're defaulting on their bonds. And that started to ripple through credit markets in China. And and actually, Crista might have some comments here too, in terms of one of the scenarios being typically when the real estate market and credit markets are contracting in an area, that is very deflationary. Your money, you end up shrinking in and people are scared. And there was a concern that would spill over. It hasn't at this point, but I think it's, if you had held high yield domestic Chinese bonds, your returns wouldn't be looking so hot right about now. So Crista, curious what your comments on that deflation scenario, and if you have anything to add to China.
Yeah, I mean, I think the real takeaway here is there are multiple scenarios. There are different things that could play out over the course of the year. Obviously, as Paul alluded to, if you're deleveraging in an economy, if your money supply is shrinking, that is a deflationary trend, and that is typically rates lower. I think the real risk within China is, if that ends up being in the banking sector and it causes sort of more of, becomes more widespread, we'll see if that happens.
Okay, so essentially there is never a dull moment. And speaking of not dull, Christian, this question is being voted up in Slido right now. How do you view the excitement around people making fortunes off of things like meme stocks or NFTs? Is there a risk of this, and Paul, I'm using the term now, spilling over and impacting either the real economy or the broader market?
Okay, I will not pull a communist joke here. But I appreciate the word spillover. So I'll start with, a very old stock exchange or financial wisdom. Nothing is harder than seeing your neighbor get rich. And yeah, I think this is just an old theme, a repetition of a very old theme here. First of all, what's the context? Well, the context is that over the last almost 2 years with COVID, governments and central banks, both together or independently, have flooded the markets and the population and companies with liquidity, with cash. So there is a lot of cash to go around, which of course on the other side of the equation is government debt now. But generally, what we see is all this liquidity that's slashing around, and that liquidity had to find some home. And yeah, you would expect that there's a higher chance of speculative excesses when there is a lot of liquidity going around. I'm not saying all these investments, because you said NFTs, meme stocks, and so on. I'm not saying all of them are speculative excesses, but looking at the whole in aggregate, the chance that there is some bubble building is pretty high in my personal opinion. Spillover effects. Well, there's I think three I can think of. The first one is, you haven't asked about crypto, so I wanted to say Bitcoin millionaire, but you didn't mention that. So say the NFT or the meme stock millionaire, they might buy a Ferrari or they might buy a big mansion with the money. So that's one spillover. Of course, hits the other people that want to buy houses or Ferraris, but I think that's pretty limited. The most serious one, in my opinion, is that everyone sees this, and this leads us back to the neighbor analogy. So I think seeing people get rich with some of the meme stocks is leading people to take more risk, because it seems the signal the market is sending back is, hey, risk taking, even crazy amounts of risk or amounts that would be considered crazy under other circumstances, seems to pay off. So I think a lot of people are tricked into taking more risk than they usually would, or maybe than the stage of the cycle, earnings multiples and so on would suggest. I think that's why we have people like you, Janelle, who can then have a dialogue with our clients. And I mean, if I put myself in client shoes, it's great to have someone to talk about your emotions. I see my neighbor getting rich. Should I take more risk? And that's maybe good when people don't do everything on their own, but have someone to just run by the idea. And the third spillover effect is, well, if or when this all ends. So I don't know who remembers the .com bubble in 2000, or 2001. I remember that and its impact on the real economy vividly. all of a sudden there were people who all of a sudden felt a lot less rich than they had before. And so you get into liquidations, and that's what I felt was the main impact of that period. So, but we don't seem to be there yet. So that's maybe a future spillover.
Janelle, I have an add-on, an important point and an unimportant point. My unimportant point, if I can, is that people are always trying to keep up with each other. This is why Christian wears a blue shirt and has books in the background, just like me. My important point, though, is I was on the phone with a summer student, and this person was asking me about cryptocurrency and what our position was on this at Mawer. And I said to this person, imagine that you buy 5 coins, whatever they are. And then 5 years later, you check your wallet. And I asked this person, well, how many coins do you have? And they said, well, 5 coins, Paul. So great. And then 5 years or 10 years later, if you check that wallet again, how many coins are you going to have? And at this point, this person was looking at me a little bit funny, but answered 5 coins. But my point here was that the coins don't replicate themselves. It's very different than investments that earn cash flow and pay dividends that are replicating themselves. And the comment is that this marks the line between investing and speculating. Because if you have those same 5 coins, the only way that you can make money is by selling those coins to someone else for a different price, a higher price. And that could actually be a lower price. At Mawer, we're in the game of compounding, mathematically compounding investments through the reinvestment of those bond coupons or earning streams or cash flow streams or dividend streams. So I just wanted to point that out. It's a very important mathematical principle. And Christians, stop copying me with your dress code.
Christian, any rebuttal?
Yes, I'll rebuttal to the serious stuff he actually said, and because there was some in there. It's income producing assets. If you own an apartment to rent out, that's income producing. If you own a bond, that's income producing. A stock that pays you a dividend or grows, that's income producing. But I think actually the comparison, Paul, you made there, I've heard that similar one from Buffett on gold. I mean, put gold down in the earth and see what grows. Nothing grows because gold or Bitcoin or NFT, they're not income producing. So I think that's the main difference. Yeah, no other rebuttal. I was wearing blue shirts first, but hey.
Okay, so speaking of income producing, let's move back to Crista for a second here. Crista, I know you've explained the role of traditional fixed income in a balanced portfolio, but investors are wondering if Mawer is still considering any bond alternatives, such as preferred shares or REITs or utilities or otherwise. Could you comment on this?
Yeah, sure. I think I think Paul will have some thoughts on this, but before I sort of pass it over to him, I'll just briefly talk about what we're working on the bond team. So most of you know, we've updated our IPS to allow for foreign bonds, and we're currently working on developing a process that allows us to assess corporate bonds in various countries. So to broaden our credit universe to not just Canada, but to be more global. And the idea here is really just to be able to find opportunities that offer more attractive yields, more attractive risk return characteristics, so we can create more robust portfolios. I'll pass it over to Paul, though, to talk about any other alternatives.
Well, I would just say alternative-wise, the world is moving in a direction where we recognize there are both public investments and also alternative private investments that can still be run by excellent people, be wealth-creating investment opportunities. And what we're going to be doing is taking a look at how to do this. So I would expect at Mawer, when we launch a new fund, we call it a sandbox fund. We're going to be launching some sort of sand with private investments to walk down that path. It'll be done prudently. It'll be done in a measured direction, but that's just the way the world is going, and we'll evolve with it.
Thank you, Paul and Crista. So, Jeff, we talk a lot about investing in wealth creating companies. And there's a question here about businesses who are not currently profitable, but are earning huge returns for shareholders. And the question is, do we feel like we're missing out on return opportunities because of this investment philosophy?
I want to edit what you said slightly, Janelle. We invest in wealth creating companies, not just profitable companies. The difference is wealth creation is an intrinsic measure, whereas profit is an accounting measure. And so when we look at these companies, we put them through the same lens that we put through all the companies. Are they wealth creating companies with competitive advantages? Do they have excellent management teams? Can we buy them at a discount to intrinsic value? Some of these companies come up green, many of them come up red. No, we don't want them. And going back to my accounting question, or my accounting comment, the accounting world was built on the industrial economy. When you make investments, if it is a plant or equipment, it is capitalized, it does not reduce your profits in that quarter, in that year. However, if you invest in intellectual property, most often that is expensed, so whether it's pharmaceuticals or more software intellectual property coding. And so many of these companies, many of them being software technology type companies that are generating high returns, they actually, some subset of them are actually wealth creating companies. And so when we take a look at these companies, we have to adjust the accounting profits to what we think and exclude the investments. And it's a bit of an inexact science. And so there is therefore more risk in investing in these companies because the accounting rules are not as precise here. But often you can make a distinction between an expense is something that you need to spend money on so you can generate revenue today. An investment is you're building something so hopefully it will generate revenue in the future. And so whether that is a factory or that is writing a code for the next version of your software, in both cases, that is an investment. And so, for example, Elastic is a holding in our recently launched US midcap fund, as well as a holding in global equity and our US equity funds. It's the most important search company that nobody has ever heard of. So outside of browser-based search, of course, we know what company that is. Elastic is actually the dominant provider. And it's a platform that powers anything from if you use Uber to search for a driver, or if you're an IT administrator and you're filtering through millions of logs trying to detect cybersecurity incursions, Elastic is the preferred solution for all of these things. And last year, it reported a loss. Yet what we did when we did the analysis is we capitalized some portion of their investments that they're making. And as you know, at Mawer, we think probabilistically. So we ran that through a Monte Carlo analysis. And we felt that there's a 90%, we're 90% confident that its profits today, even though it's reporting accounting loss, its profit margin today is anywhere from 10% to 40%. And so therefore that is a wealth creating company. And indeed we did invest in them. What perhaps you're also noticing is at Mawer, we have a much lower weight in some of these companies than perhaps the index does or perhaps some other managers do. And that goes to the third plank of our investment philosophy, buying companies at a discount to intrinsic value. Yes, many of these technology companies have done very well. And there could be follow thy neighbor and wear a blue shirt effect with some of these stock prices. So we have to be very careful. And I think that's why active management today, more than any time, especially with technology companies, is very important because you need a philosophy to filter through the companies that are wealth creating but loss making on an accounting basis and filter through the companies that are not wealth creating and loss making on an accounting basis, and then filter through the companies that are trading at a discount to intrinsic value, as well as the companies that are not trading at a discount to intrinsic value. So yes, we look at these companies. Yes, we've included some of them in our portfolios, but our investment philosophy is probably causing us to underweight them relative to the index and some other competitors out there.
Okay, thanks, Jeff. That kind of ties into a question that we had in Slido about, in a world of low cost passive investments and exchange traded funds, they're gaining a lot of popularity. How do we view our value add for clients as active managers? And I think you sort of just described that there with how complicated it is to look at these accounting metrics and the profitability potential of businesses. Christian, I just wondered if you had anything to add there in terms of the value add as active managers.
I would say in the long run, we don't need to hide, because in the long run, it's very easily measurable. It's the alpha over the index. So how much has the fund outperformed the index? And I think on a long-term basis, we do look, most of our funds do look pretty good on that metric. The other one I would just caution against with measuring against the index, because that's also sort of the thy neighbor expression that Jeff just used. I've gone in the beginning of my career through a phase, and I started in Germany, where, well, the index in a way went through a bubble in the tech boom in 2000, because it was very internet and telecom heavy. And so the index all of a sudden showed a volatility, and of course, volatility to the downside, a drawdown that people hadn't expected from really well-balanced indexes before. So I would say that the index may not be the only benchmark, because the risk is that the index becomes unbalanced again, Janelle, therefore to the value of personal advice bundled with an alpha generating strategy.
And if I can add, actually, that was one of the ideas we had for launching a US mid-cap fund, because when we looked at US investing, the feedback we got from most people is that, well, I just buy the S&P 500 index. It's the most liquid index in the world, the most well-followed, the cheapest ETF. But when we looked at that index, a full 25% of it is the big 5 tech companies. That's an unbalanced index, in our opinion, just as Christian was talking about. And so when we looked at US mid-cap, we said, well, the universe in the US is defined as a Russell mid-cap index, which is excluding the 300 to 400 largest blue chip US companies that everyone has heard of. But hey, there's these 4,000 companies in middle America that are wealth creating, that are run by excellent managers, that our philosophy, that active management stock picking philosophy, can come in and add value. And so that was a great response of what Mawer has done to add value as an active manager in a world of increasing passive investing.
Thank you. Paul, I have a few questions here that I'm going to tie together a bit. So have we invested in any green energy producers? Second is, how are we mitigating risks due to climate change in our investment decisions? And the last one, so feel free to pick this apart a little bit, is just how do we consider ESG when making investment decisions? So the environmental, social, and governance concerns that investors may have.
Okay, lots of questions there. Let's start off with, do we make direct investments in clean or green energy? I mean, I think for us, it's about exposure and picking and choosing our spots. That example of ICE, Intercontinental Exchanges, that's a great example of something that you wouldn't see from the outside, but actually they are making progress on markets that facilitate green energy. So they are driving that change. One of the things to consider is that even though there's going to be a ton of money that goes into energy the transition that will occur in the future, some of it is going to be very commodity-like. And we have to remember that we're still in the business of earning above average returns. The companies have to have a competitive advantage. So, there's going to be lots of spots that don't make sense, even though capital will have to be deployed. We're going to find the smartest ones. Now, ESG has been a major theme and topic as long-term investors. And remember, we're often holding public companies for a period of 10 years. We have to think long-term. We have to think about these factors that are very long-term in nature and might represent, I'll call it, an off-balance sheet liability. It's been more recently where we've spent more time carving them out so we could communicate what we're doing around ESG. 15 years ago, when I would write the management team a letter about their compensation and request a meeting, that was just being an engaged shareholder, but it was never labeled as a governance issue or as an ESG issue. What listeners should understand is that ESG is part of our process. It's part of our investment process, and actually people are compensated on following our investment process. So that's all tied up together. We have our responsible investing philosophy that goes something along these lines. One, we're still interested in above average returns, below average risk. But we recognize that these ESG factors can and do impact the valuation of the company. We look at them in our models. We look at the qualitative risks and opportunities in all the reports. We engage with the managers and we run an integrated process. And that's really important because the same analysts that are involved in identifying the risks, that are talking with management teams, that are providing feedback and also voting proxies, it's a closed loop system. It's actually a very powerful system, and we're capturing that. So we actually capture those engagements, and that's all in a computer system, M42. And then lastly, it's important the strides that we've made as a company, because I believe one of the first principles of leadership is it's not just about telling someone else that they have to do a better job. You have to start to get your own ship in shape. And we've made strides in terms of creating an internal ESG committee and look at what we can do at Mawer Investment Management as a company. And there's been some initiatives that have paid off over the last few years. So that in a nutshell is ESG. I'm not sure if you want to dig into that at all, Janelle.
No, I think that was really well answered and important to share. So thank you. Back over to Crista. We have a question in Slido. What, if any, are the long-term impacts of the amount of outstanding debt, both federal and provincial, going to have in the future?
Yeah, I mean, I think just sort of debt in general, particularly Canada. I'm assuming we're talking about Canada here, so I'm gonna stick just to Canada. But debt in general is effectively deflationary, because if you're borrowing today, you're basically borrowing today using future income. So you have less spending in the future. So I think of debt as sort of a constraint on future growth, just very high level. In terms of Canadian debt, Canada actually doesn't have a significant amount of debt relative to other countries. We had a big, they added a lot last year, obviously, through the pandemic, as all countries did, but we're still actually sitting in decent shape from a federal perspective, at least in my view. On the provincial side, what's been interesting is, again, they added a bunch back in through the pandemic, but budgets have actually been coming out better than expected. And that's a result of higher nominal growth, so higher inflation. So if we do get that inflation, I think it's the government sectors that you can potentially deleverage faster than private sectors can. But ultimately, our view is that debt from an overall perspective, it kind of limits how high interest rates can go, all else equal, and it is a headwind to growth in the future, all else equal.
Does anyone have anything else to add on the government debt question?
Well, the only thing that I would add, Janelle, and Crista's alluded to it before, is that the more debt you have today, it pulls forward future demand. And I think that's just a really nice way of understanding the impact of debt.
Thanks, Paul. Switching gears again, there's a question about how we consider participating in an initial public offering or an IPO. And would the balance of power be held by the seller in those scenarios? I thought maybe Jeff could take this one and possibly share an example with us of when we've participated in an IPO.
Sure, Janelle. Yeah, so we view IPOs as we do other publicly traded companies. This is one potential company that we can consider for our investors in our universe. Absolutely, there are two potential downsides of an IPO. The first is legally, they only need to disclose, depending on the jurisdiction, 2 to 3 years of historical financials, as compared to some companies that have been publicly listed for a decade or more. So we have less information to go on. And then the second piece that you're alluding to is perhaps the balance of power is with the selling group, whether it's a management team or some private equity group or some other owner that's selling the company to the public shareholders. Implicit in that second comment is a view that perhaps it's a bit of a zero-sum game. People are trying to pull the wool over the public shareholders' eyes. They can, make a couple more bucks per share on the IPO at the expense of public buyers. Our general experience is that while that does, of course, happen sometimes, most companies are not necessarily trying to go public to play a zero-sum game with public shareholders. They view public shareholders as a source of ongoing capital. Once they're public, they can do secondary offerings and continue to access more capital to grow their business. And in many cases, these companies that are coming public are wealth-creating companies that are looking to build their businesses and compound over 5 or 10 years. And in those cases, it would be unwise for them to essentially pull the wool over the eyes of shareholders. So that's the context by which we look at it. And I guess the only tweak really from our process standpoint is IPOs typically are a bit of a shorter time period, and the history on the company itself is a little shorter than what we are used to analyzing. So the shorter time period can be made up by being responsive and having a strong team. And we think that at Mawer, we've consciously chosen to limit the size of the teams at each of our asset classes, because while people scale linearly, the lines of communication scales exponentially. And so if you have 10 people and an investment committee on top, you may not be able to participate in IPOs because you can't respond quickly enough. And so at Mawer, with a model where one leader on each fund decides the trades of that fund with the input of the rest of the team, that model actually allows us to participate in IPOs, because often there are also opportunities on the flip side within IPOs. And then the second piece of, there's a short history of financials and disclosures. We try to get around that by understanding the company more by doing something called scuttlebutt. And this, I think it's an old naval term. Somehow it's become now an investing term, just like blue shirts. Now it's become a thing for investors to always wear. It is very important as part of our investment process and that deep, intensive analysis that we do to do scuttlebutt on these companies. So we would go talk to suppliers, we talk to competitors. In some cases, the competitor might be publicly traded with a decade of historical financials, as was the case with a recent IPO that we participated in Canadian small cap, Magnet Forensics. Its competitor, Celebrite, actually was majority owned by a Japanese company that was public. And so we were able to see how this industry has developed over a decade. But by doing all this scuttlebutt, by accessing multiple sources of information, we can triangulate on whether or not the management team is generally presenting things fairly and factually, or if indeed there maybe is an angle there that they are trying to pull the wool over the public shareholders' eyes. And then the other, I think, piece I should mention is with the push into US mid-caps and having a Canadian small cap team member kind of be involved in that. In Canada, we participated in IPOs for many years. For example, back in 2015, we bought Sleep Country in Canadian small cap. It was a $17 a share IPO. Today, it's trading around $39 a share, and that's including about a 2% dividend yield along the way. Just to give an example that, hey, you can make money with with steady Eddie companies that come to IPO. And recently in the US, both the US equity and US midcap teams participated in a company called Ryan Specialty, which is an insurance broker in that market. And this was a big moment for us as a firm because this was the first time that our team participated in a US IPO, one of the most competitive markets in the world, where Mawer, that little asset management firm out of Calgary, was able to get one of the lead orders and one of the biggest allocations on that IPO. And this, again, was another case where the founder, Pat Ryan, didn't want to price the IPO perfectly and kind of pull the wool over the shareholders' eyes. In fact, he probably underpriced the IPO. Since July, that stock is up 63%. And so Mawer and you, our client, being a lead participant in that IPO is, we think, a value creation opportunity for our clients.
Thank you, Jeff, for that explanation. Unfortunately, our hour-long session has quickly come to an end. I know there's a few more questions in Slido, and certainly if you have any other questions as listeners or clients or investors, please do feel free to email them to the info@mawer.com address or reach out to your investment counselor or advisor directly to discuss in more detail. So thank you to each of our panelists today for your participation and a great discussion. We appreciate your time and enjoy the rest of your day. To everybody who tuned in, we hope you stay safe and healthy.